Hi everyone, welcome to BG Private's New Rules in Aged Care webinar. I hope everyone can hear me. I'm going to keep admitting people. There's a couple of people still joining in. So as they join, I'll just glance down and keep admitting them. Thank you so much for joining us on a Thursday afternoon. Adrian, if you could just slip to the next slide.
Brilliant.
All right, so just a little bit of housekeeping while I keep admitting people. Everyone's mics will be muted, but there is time at the end of the presentation for questions. So all you have to do is click on the Q&A button at the top of the top menu, and I will go through them and we'll answer as many questions as we can at the end of the presentation. Adrian, if you could just flip back one. Yes, so the recording will be sent to you after this meeting's finished. So there'll be a lot of information that you're going to hear today, but the recording will be sent to you. So please don't panic that you have to take everything in right now. Contact details for our experts will also be sent to you. So don't worry if you would like personalized advice after this meeting, you will be able to book in an appointment with our experts. And just a quick disclaimer, so this is general information only. We're not providing specific financial advice. This is just general financial information. The full disclaimer is at the end of the presentation, so when it is emailed to you after this meeting, you will be able to see all of that as well. So once again, thank you very much. Our speakers are Adrian De Mello, who is one of our financial advisors, and he's our aged care expert. Tim Olenek, who's the partner of our tax advisory division, our expert in tax, complex tax, and Han On, he's the partner of our self-managed super fund management division, and you'll be hearing from all three of them today. So Adrian, take it away.
Thanks, Hilda. Thanks, everyone, for tuning in. We've got a lot to cover, so I've been really ambitious with this webinar. So without further ado, let me just start. We're going to talk about some home care, residential aged care. There's a few case studies I want to touch on, and then we'll have Tim and Han some questions for them that clients at this stage of life generally ask or we come across. And then we'll open up for some question and answer sessions. So hope that we get to have everyone on for the next 90 minutes. So aged care or assisted living or supported living, what are the options for residents or for the elderly? We start off with the Commonwealth Home Support Program. Now, this is commonly offered by the council. However, with the cost piling up, we're going to see a phase out of this support around the 30th of June 2027. So in 2 years, we won't have this service on offer anymore. Then what we do have is the support at home. This is a new name, or we used to call it home care. This is where you get tailored packages, and the government supports the package for you. And finally, as it becomes tougher to stay at home and for people to assist you, you move into residential aged care for around-the-clock support. So let's start at the first part. This is where the changes have come through in the support at home service. Having a look at this this slide, under the old rules, there were 4 service levels. The first service level meant you needed less help, and the fourth one meant you needed a lot of help. And in providing more help, the costs were obviously higher. So packages range from $10,000 right up to $63,000. Now, to clearly define the level of support, the new rules have now extended to 8 different levels. And I guess their funding is roughly around the same level, anywhere from 11 grand to 78 grand. In addition, we have two extra services, restorative care and end-of-life care. So for instance, if you come out of hospital and need support while you're at home, rather than going into respite, you could get some assistance. And obviously, end-of-life care, if you're unable to have any additional assistance in a hospital and would like to move home and spend that, those precious few days with your family and friends, then there's some support available as well. So the support at home program, the newer changes split the service types into three main levels, three areas. The first one is clinical care, where it's all about providing medical or some form of medical care, allied health, nursing care, nutrition, care management. It's all the services that are already in place. Then there's this concept of independence. This is where you have people wanting to live at home and be independent. So there's personal care, social support, respite, a bit of help going to and from hospital appointments, shopping centers, etc. And then you've got everyday living. This is assistance with meals, cleaning, home maintenance, and repairs. Now, this next part is giving you a perspective of how this is currently being viewed by the government. So under clinical care, you don't need to contribute towards the cost. You're completely 100% covered by the government. When it comes to independence living, the government is happy to support you as well. A full pensioner will only need to contribute up to 5%. If you're a part pensioner, you'd be expected to contribute a bit more. And then self-funded retirees are going to contribute the full amount, which is up to 50%. Shouldn't say up to 50, it's the full 50%. Everyday living. Now, there's an expectation if you're having issues with doing tasks that you would previously do, then you would need help, and it's expected that you would pay for them yourself as well. So accordingly, you'll find that the contribution level is a lot higher. So by splitting this into three clear categories, this is one way of keeping the cost of the government contribution in check, so more people can be supported. So going through the changes, the old rules saw two types of fees. One is the basic daily fee, and then there used to be an income tested fee. The more income you had, the higher was the fee that you paid, or the less the government contribution. The new rules is meant to keep it very simple, and deciding on the type of care you need, you would come up with a participant contribution amount, and that's all you would need to pay. When you're calculating this contribution rate, it's means tested. So there's a whole number of steps that are used to come up with that contribution amount. You can either do a course, or if you're fortunate enough, we've got a number of calculators supported by product providers or trading agencies, and also available on the Aged Care website. I'd like to now just go through a simple case study to give you an appreciation about the cost of care of what an average Joe might be paying. So we've got the average Joe. His name is Brett, and he's approved for home care. He's single, a homeowner, and a part pensioner. He's got about $350,000 in the bank account. So by no means is he, extremely rich, but he's got sufficient assets to support him. This is what he'll pay in cost. He won't have to pay for clinical because nobody does. There's that level of independence. So if he chooses services from that area, then he would only need to contribute 8.65%. And for everyday living, which is the biggest percentage of contribution, it's only 22%. So that can extend right up to 80%. So somebody like Brett would only ever pay around 22%. Now, there's certainly a lot of people currently on a home care package. And if you're familiar or know someone who's in receipt of this package, you know how long it takes for the assessment to come through and then for a package to be awarded. So if you're on the OLK, some of the questions might be, what's going to happen? Now, these rules legislation was passed on the 12th of September. So even though it's 1st of November is the start date, there's some grandfathering that will extend way back to last year, being the 12th of September. So on the 12th of September, if you were receiving a home care package, or you were currently being assessed for a home care package, then there's this principle of no worse principle. What that means is, under the old scheme, if your contribution was lower than what it will be now, then they will reduce that to match the old terms. Okay. Now, if you were receiving a package between the 12th of September and the 1st of November, and you had some unspent funds out there, then you would be able to carry on using those funds to support your care. Another way to look at this cost, previously, you'd have up to 35% being tied up in administration. You've got the aged care provider managing the contact between aged care, Department of Aged Care, and yourself, then managing the staff that were providing support. So those costs were getting out of control. And with the new rules and simpler rules, the aim is to keep that management cost right down to a maximum of just 10%. So once again, when you receive the package, more of it will go towards supporting your care. That's, I guess, giving you a preview of the home care. Our focus today is going to be mainly on the residential aged care. To start off with, you need to have an ACAT assessment. This is where the aged care assessment team will assess your suitability to move into a residential aged care facility. Generally, you will be in a hospital, and it's determined that it's most likely you wouldn't be able to look after yourself. So you would go firstly into respite and then move into permanent care. So respite is temporary care. I guess it's to get a sense of what aged care or residential aged care is all about and the types of service, and to get a flavor of the living conditions out there. So the second part is to find a suitable facility. There's plenty of help available. There's plenty of services on offer to help you find a facility. And finally, this is the part where I, as a financial advisor, help with setting up the finances, illustrating the cash flow, showing you ways to fund the various costs associated with residential aged care. The My Aged Care website is extremely helpful. There's plenty of information. Unfortunately, sometimes there's so much information out there that you might get lost. So you'd really need to know what you're looking for. They've had a revamp. It's got a new look. and the search has changed a little bit. Once again, trying to make it easier for you to get that information. So let's start looking at the cost of aged care. Now, in this time, things are getting really complicated. So I try and have a conversation to keep this as simple as possible. And I've broken this down into 4 main categories when you're looking at the cost. The first part is to secure your accommodation. So there's cost involved with that. And possibly we'll spend the most time on this area, in this area. Then there's what we call your living expenses. Then there's the cost of care. This is the additional cost that you would be likely to spend when you move into care. It is means tested, so we'll go through that as well. And finally, what I like to call the lifestyle. So while you're in care, if you want to take advantage of additional services, then it's a lifestyle choice, and you'd certainly pay out of pocket for this. So cost, starting off with the cost of accommodation. Now, when you find a room, the way you pay for it is called a refundable accommodation deposit. Okay, so you place a deposit. The name should suggest it's refundable. And when is it refundable? When you leave the facility, it's then going to be refunded for you. Now, some of the changes that have come through actually started from the 1st of January. The government sets this prescribed maximum amount that a place can charge. I've got minimum, yeah, it's really the maximum amount, which used to be 550,000 and hadn't changed for a long while. In order for it to be changed, you needed to pass legislation. So first up, they went 1st of January, the new prescribed is 750,000. You still get places that charge a lot less than this. Second change is, instead of waiting for legislation, automatically on the 1st of July every year, this maximum amount will keep on increasing. I talked about places charging a lesser amount. We have facilities that can charge a lot more. So imagine in a opulent area where land prices are expensive, it would cost a lot to build a aged care facility, but it is a requirement. There's people to service. So in that case, the facility can apply to charge a higher RAD. So I've seen RADs as high as 2.5 million charged. When a facility applies to have it charged, a high amount charged, that approval only lasts for 2 years. So it's important that if you see these really high charges, make sure to confirm that they have approval to charge that higher amount. This is the one that is the biggest increase in cost. Now, what is it? When we paid the RAD previously, 100% of that would be refunded to the estate. Now, in order to subsidize the facility a lot more, residents are required to pay up to 2% each year of the RAD that is deposited. So this 2% can only be charged each year for a maximum of 5 years, so effectively 10%. There's a few more details with regards to this 2% retainer. So it starts being charged as soon as you make the first deposit. So I'll talk in a while where you may not have all the funds available to pay the 100% of the RAD upfront. So if you put a partial deposit, as soon as you do that, the 2% will start. And then 2% will only be charged on the actual amount that you deposit. What if you don't have the funds to actually pay the RAD, then you're required to pay the interest that you'd expect the facility to otherwise earn on the RAD that you got deposited. What's the rate of interest? It's called the MPIR. And remarkably, I remember what it is. It's the maximum possible interest rate that can be charged. At the moment, is currently 7.61%. So imagine for a place that advertises their facility, their room for 750,000, that would cost someone who doesn't have the funds up to $57,000 a year, or $156 a day. Previously, this rate would remain the same for the entire stay. However, with the new rules, once this amount is set, so for instance, you enter today, it's 156, then twice a year with CPI, in March and September, this $156 would increase. A common question I get is, can I pay a mix of RAD and DAP? Most certainly. So I see a lot of the time someone would hold on to cash in a bank account while they're waiting to sell investments before they can pay the entire RAD. Now, you're hardly going to earn 7.61% in a bank account, let alone a term deposit. So it makes sense as soon as possible, you can pay the RAD, you'll be saving that amount of interest. The second thing is, it might be taking an extended amount of time before you can sell your investments, or for whatever reason, you just can't pay the entire RAD. And cash flow and liquidity is a squeeze. So if you pay a partial RAD, you can also request for the DAP to be charged to what you've already paid. So over time, as the DAP is charged, your RAD will reduce. Okay, so this is just options of managing your cash flow as well as saving interest and keeping your overall cost low. What if I can't afford a RAD? So in the situation where you can't afford a RAD, most likely you are deemed as having low means. And what does this mean to have low means? In essence, for a person who's got accessible assets under 210, keeping in mind there's no other income. So when I talk about no other income, perhaps they're receiving an overseas pension, then it changes the equation. They might be receiving a lifetime pension for having worked in the government. That would change the equation. But generally, if you have under $210,000, you would be assessed as low means. And what happens in this case, you don't have to pay a RAD, you don't have to pay the DAP, the government will assist with cost. However, you may be required to make contributions. And there's a segue into the new name and the new acronym, Daily Accommodation Contribution. So similar to the DAP, you pay a DAC. But the most you'd ever pay is $70, $71, a lot less than $157, right? Now, if you chose that you don't want to make this regular monthly payment and you have the option of paying a lump sum instead, that's not called a RAD. When you pay this in lieu of a DAC, it's called a RAC. So you have the RAD, you got the DAP, then you've got the DAC, and then you have the RAC. Okay, bottom line is you don't need to remember half of this if you're not low means. Some of the strategies to consider when you're looking at your accommodation cost. and we're only on the first part. So I've talked about this before. Use as much of your liquid assets, and that's a way of saving 7.61%. Additionally, if you're not on the full age pension, or perhaps you don't receive the age pension, by moving your assets that are previously counted and paying a RAD or a RAC, it's not actually assessed for the age pension. So suddenly you'll find residents with their Centrelink pension increasing or receiving the age pension for the first time. Imagine the joy they feel. Staggering entering if you're part of a couple. So the next illustration I have is Hong and She. Effectively, they both want to go into care. Hong needs care more than She. So we're going to assume out here that they're both going to enter into a facility at the same time. They've got personal assets of $10,000, $250,000 in cash. They spend about $10,000 a year in addition to their general living. And their current age pension is $30,000. It's the full age pension. Now, let's assume out here that the aged care facility is going to charge them each $750,000, or if they're unable to pay that, then they're going to pay $156 in interest per day per person. More realistically, you're going to have this be able to negotiate a much lower RAD. So they go into care, they have to sell their home because they don't have the cash, and they certainly don't want to be paying 7.61% in interest. Now, because they paid the 1.5 mil, there's a retention amount, which is 2%, $30,000 a year. Over 5 years, that's $150,000 in additional cost. While they're selling their house, they've got to pay a DAP, which is $156 a day times 2. And after they sell the home, there's not much left, right? Let's look at option 2. I like this option. I think you'd like that as well. Since she is staying at home, the house is not counted under the means test. And then with the leftover assets, it's split into 2. So when Centrelink is assessing the assets, Hong comes out to have low means. And if you've been paying attention, if you have low means, you don't have to pay a RAD. So Hong enters care, then she needs to move into care. So what they do is they decide to sell the family home. Once they sell the family home, there'll be an influx of cash. The low means assessment doesn't change. Hong is always going to be considered low means. However, now, because they have cash, he'll need to start contributing to his care. But the most he needs to contribute is $70 a day, and that's what we call the DAC. He could choose to pay $340,000 as a RAC, still a lot less than the $750. When she enters, she is required to pay the full RAD of $750,000. But if you add both of them together, they would have paid a combined amount of over $1 million. The facility won't be retaining $30,000 anymore. It will be $21,000 a year. So there's some additional savings. The leftover funds are going to be a lot more substantial, of $659 compared to the first option they take. So it does make sense to look at your options and come up with a strategy so you can keep your cost, especially your accommodation cost, where you find the bulk of your cash flow going towards. You can keep them as low as possible. So we talked about the accommodation. The next cost we have, I term them as living cost. What's living expenses? Think of it as the general living cost you'll incur: food, utility, laundry, etc. These are the types of costs you would expect to pay if you were living in your own home. For aged care purposes, it's called the basic daily care fee. It continues to increase twice a year. Everyone pays this, and it's currently $65.55 per day. Just to give you some perspective, it's the equivalent of 85% of the full single age pension. So that's a very simple cost. We move into the next big chunk, the cost of care. Previously, we just had one cost. Now they've got two costs calculated separately. The first one called the hoteling contribution. Previously, this was 100% covered by the government. Now, with the new changes, you would need to pay for them, but only if you have the means. The most it would cost you is $22 per day, or eight grand a year. So this was a cost that you didn't have to pay before. Then the second part of the cost, it's got a new name, non-clinical care contribution. Previously, this was called the means tested fee. I guess part of the naming convention is to show residents where these costs are actually going towards. This is capped at $100 a day. Under the old rules, some residents, for varying reasons, could be charged up to $400 a day. So that would no longer apply. Additionally, there's an annual cap of $38,000. That hasn't changed much. However, the lifetime cap has definitely increased from about $85,000 to $135,000. Now, there could be this case where you don't pay the $105 a day, so you're paying a smaller or a lower fee. So while you're paying this non-clinical care contribution, there's a maximum of 4 years that it can be charged, regardless of whether you meet the cap or don't meet the cap. It can only be charged for 4 years. So a bit of respite for some. And finally, we have the lifestyle cost. This is extra and most commonly what we hear of. If you'd like a choice of vino with your dinner, then you're going to pay a bit extra. You know, if orange juice doesn't cut the mustard out there. A physical newspaper. So you still like, you know, old school, get a physical newspaper, turn the pages, get your hands dirty. You don't want to use an iPad. Then a physical newspaper is the way to go. This part has totally been revamped, and it's called the Higher Everyday Living Fee. No acronym though. So when you sign up to this service, there's a cooling off period, something you didn't hear of before. There's a yearly opt-in. So if you're listening through this, it sounds like a subscription service. You're able to cancel through the 12 months at any time, providing sufficient notice. Now, if you have been receiving care previously, for everybody, if you've been in care, then facilities have 12 months to transition existing residents to the new package. Otherwise, everyone in residential aged care prior to the 1st of November. Everything else, all rules apply. So whatever I've discussed in today's presentation till now applies to residents moving into care from Saturday onwards. In discussing aged care, the family home comes up a number of times. So let's look at some of the aspects of the family home. So it's exempt from the age pension. It's exempt from the aged care assessment and the aged care pension calculations indefinitely, as long as there is a protected person that continues to live there. Okay, so who is a protected person? How are they defined? So we look at them as a spouse, a carer. So you have maybe a child who's living with parents for the last 2 years and they need to be receiving a carer's pension. A close relative. A close relative that has been staying in there for the last 5 years. They may not necessarily need to be receiving any form of Centrelink support. Now, if that's not the case, for the age pension, the home is not assessed for 2 years after the protected person has left the home. So until the last person has left the home, for age pension purposes, the home is not counted. So there is some relief in there. And this is one of the reasons where you might consider to delay the sale of the home. Why? Because your income would be a lot higher from the age pension. Now, under the aged care means testing, when your home is counted, it is capped at $210,000 per person. What does this mean? If you were considering selling your home, the full value of the home would be counted. And under means testing, your fees would be a whole lot higher. So there is always reason to consider the potential to keep or maintain the family home and possibly rent it out. The next section looks at a few aged care scenarios. This is just to give yourselves an idea of the various costs and how various people can afford this care. First off, we've got Margaret. There's an advertised RAD of 400,000. So not every place is going to be charging 750,000. And all she's got is 100,000 in term deposits with 10,000 of personal assets. Margaret enters care and she decides to pay a RAC. So a RAC should give you a hint that that Margaret's been assessed as low means. And she holds on to the other 50,000 in term deposits. What's her cost? Firstly, let's look at her income. She's on the full age pension. She's earning a bit of interest, not too much. Everyone pays the basic daily care fee. She doesn't have any means tested fee, so no hoteling cost, no non-clinical care cost. There's an unpaid RAD, so she's paying a bit of DAP. And then what we've got out here is, sorry, it wouldn't be the DAP, it would be the DAC. And then she's got a surplus. So someone with a small amount of money, there is the ability to more than easily manage the cost of care. Now we've got Yvonne. she's slightly in a better position. She doesn't have 100,000, she's got 250. The 250 is over the 210, so she's required to pay the RAD. So what would happen in this instance? Her costs start increasing and increasing rather substantially. And you'll see that she's got a shortfall of about $10,000 a year. But because she's holding on to $50,000, she can incur these costs for a period of time. Don't forget, after 4 years, she's no longer needing to pay any means tested fee. Okay. And then we've got Michael. He's essentially a lot better off. He's got $900,000 in assets, and he decides to pay all of the RAD and maintain 300 in a term deposit. So once again, we're looking at the full age pension or close to the full age pension. However, his means tested fee is significantly increased. He's still not paying the maximum, and there is a shortfall of about 20 grand a year, but he's got plenty of income to cover that on an ongoing basis. Let's talk about some additional considerations that have come across at this point of time. Some questions. So often I'll hear, well, the family home isn't assessed under age pension. Mom and dad have moved into care. Can mom and dad transfer this to me? Well, while it's still not counted, you can't gift it to children, because then it will be counted as a gift and the full value of the home will be counted, and it will be counted as a deprived asset for the next 5 years. So possibly not the best move. I think I've touched on it in a different setting, but a RAD can certainly be negotiated down. Think about it. The facility was already in existence well before the 1st of January when the RAD changes came in. So you should be able to negotiate a lower amount. Additionally, as a financial advisor, or you can get assistance, you can write up a letter or an email, just as simple as an email describing your situation in the case where you have illiquid assets, and you might be able to convince the facility to charge you a significantly lower amount than what you'd need, than what is advertised. A power of attorney is definitely required to negotiate with the facility, especially if the resident going in has lost capacity. So that's extremely important. If you don't have a power of attorney, then you would be required to apply for letters of administration. In Victoria, that's with VCAT. At the end of the day, you're signing a contract, so they need to be signing one with a responsible entity. The RAD or the RAC, the deposit that you pay with the facility, is returned to the estate. So you might think that you are having, as power of attorney or the child, you're having this whole conversation with the facility, you're signing paperwork with maybe some expectation that the money will be returned to you. That does not work. The facility can't take that risk, so they will only pay that to the estate. Additionally, if you have lent your parents the money, it is worthwhile setting up a loan agreement. Otherwise, the RAD is returned to the estate. According to the will, it's transferred to all children, so you don't receive the full value of your money. And finally, it's only returned once you apply for probate, which can take a couple of months and even longer. So it's a while before you will see these funds returned to you. The next section, we're going to call upon our resident experts. The first of them is Tim Olinek, who's our tax partner. I've got him here because a number of times we'll have questions that are tax related, and I rely on his expertise. So Tim, thanks for being here. Are you ready? It's time on the hot seat.
Thanks, Adrian. Great presentation. Thanks for introducing me. People often say that you judge a good tax advisor by the amount of grey hairs they have, and that must make me getting better by the day.
Fantastic. Mate, on occasion, we'll have clients or their children wanting to transfer ownership or sell the holiday home in conjunction with transitioning into aged care. Obviously, no one's using it. Would you mind making some comments on such a transaction?
Yeah, sure, Adrian. There's probably two situations there. One where the holiday house might look to be sold just to realise cash, or alternatively, the holiday house could be transferred from parent to child, just as a gift. Now, under both scenarios, that is treated as a capital gains tax transaction. There is a disposal for capital gains tax. So the first question to always ask is, was the property held by the parent, was it originally purchased prior to the introduction of capital gains tax in September 1985? If it was acquired before September 1985, the sale might be what's called CGT free, capital gains tax exempt. If the property was purchased after September 1985, there will be potential capital gains tax implications on the sale of that property. And if it's gifted to a child, that transaction will be deemed to occur at market value. So just because the property is transferred for nil to a child, for example, any capital gains tax would be calculated by reference to an imputed market value of the property. So when you're dealing with capital gains tax, you have to calculate, obviously, the value of the property on the sale, and the other relevant factor is the cost base of the property, because the capital gain is the proceeds of sale less the cost base. And the cost base of an asset like a holiday house, that could include not only the original purchase price of the property, but things like the original stamp duty paid on purchase, plus all types of holding costs that you've held along the way, like land tax, repairs and maintenance, government rates, etc. So that's quite a complicated process.
Thanks for that, Tim. Really comprehensive answer out there. I probably wouldn't have answered half of what you did, so thanks for that. And that's the benefit of actually going to a tax advisor when you're asked a tax question. Lucky we've got Tim in-house. Let's go to the other question that I get. I've talked about aged care and the implications with the family home. With the resident no longer living in the family home, so the home's vacant, can you please explain how the sale of a client's home would be treated for tax purposes and whether there are any unintended consequences that can arise?
Yeah, so Adrian, the base case position is that if a property has been lived in as the principal place of residence of a person, there's no capital gains tax applicable on the sale of that property. But imagine the situation of where a parent has lived in a property for a period of time as their principal place of residence, and then they're required to leave the property to move into aged care. And that property that was their main residence may be vacant for a period of time, or it may be rented out for a period of time because it's no longer used by the parent. The tax legislation actually contains a concept called the absence concession, and that allows a taxpayer to actually treat a property as their principal place of residence for a period of 6 years after they move out of the property, if they're renting the property, or they can treat it as their principal place of residence indefinitely after moving out if the property remains vacant. So a situation where, I'll just give a scenario where a parent has moved out of their principal place of residence to move into aged care, say for a period of 4 years. If the property is then sold at the end of the 4 years, it might be sold still while the parent's alive, or it might be sold as part of an estate. It would still be exempt as a consequence of being the principal place of residence of the parent.
Once again, mate, thanks for that comprehensive answer. You'll probably be scoring full marks. The final one for you. There's a common scenario we face with older clients that have a rather than large share portfolio. Firstly, how does the estate determine the cost base of these shares? And if the estate were to sell these shares, are there any strategies to reduce the capital gains tax? Now, I'm sure everyone is keenly listening and keen to hear a zero tax bracket on these shares.
Yeah, thanks, Adrian. I don't know if I can get you a 0% tax rate, but we can always try our best. And look, this is a very difficult situation where, and it's not specifically a question relating to aged care, but it is a question that comes up relating to estate-related matters, and where a parent held a share portfolio and passes, the first concept that the estate or the children need to ascertain is, well, what was the cost base of those shares? But you can't work out a capital gains tax calculation if you don't know the cost base of the shares, and that can be really difficult determining the cost base of shares, where since the date the shares were originally purchased by the parent, there's been share splits, bonus right issues, demergers, all those fancy things that the big publicly listed companies do from time to time. There are resources out there, though, that help you calculate the cost base, and we can help with that too. Now, when shares are sold in a deceased estate, the deceased estate itself will pay the capital gains tax on the sale of those shares. So just a strategy that could be used. I don't know if I can get you to a 0%, Adrian, but you could sell shares over the period of the deceased estate progressively. So if the deceased estate runs for, say, 3 years before it's fully administered and finalised, the share sales could occur over 3 years to get the benefit of 3 separate concessional tax rates that deceased estates get. Whereas if the deceased estate sold all the shares in 1 year, you're only getting 1 year of benefit of the concessional tax rates that deceased estates get. Whereas if you sell the shares over 3 years, you get 3 years of that benefit. But I don't know if I can get you to 0%, Adrian. I might be able to get you a lower tax rate.
A bit disappointed out there, team. But once again, really comprehensive. Thank you so much. Team will be available shortly after for additional questions if you have any from our audience. Next up, we have Han On. He's our division head of the SMSF team, and he comes with just as much experience and expertise. Thanks for being here, Han.
Thank you, Adrian. Thanks for having me, everyone. I've done a bit of Photoshop on my photos there, so they look younger than Tim.
Mate, in your experience over the years of managing administration and compliance for self-managed super funds in particular, are there any matters in particular that are more critical for an aging member compared to a younger member?
Certainly are. And apology, I've got this itchy throat and coughing business going on, so from time to time,
you're working too hard, Han.
Thank you, Adrian. You're too kind. Yeah, so there's a few things that I will look at for aging members of a self-managed super fund, which I refer to SMSF, of course. The number one is I'll probably get them to review the death binding nomination, because it's one of those things can easily be set and forget. With all the latest changes and the non-lapsing, you can easily set it and you forget about it for 5 and 10 years. So definitely review the death binding nomination to ensure that the person you nominated is still the one you want to. Generally speaking, if the husband and wife are still around, you normally nominate each other. But if there's only one member left, then it's important that you review who you're going to go to upon death. And number two, it's good to work with the accountant to just roughly work out what would be the potential death benefits tax if the benefits are paid to a non-spouse, adult children, that is. Because in super, only the spouse or financial dependents will receive the super fund benefits tax-free. Adult children and non-spouse and non-financial dependents, there will be a death benefits tax payable on from part of the super fund benefit. So do speak to your accountants or give us a call. We can quickly have a look at potential I call it death tax benefits.
I'd assume, Han, you would have strategies that would help reduce this tax.
We certainly do have. We have worked with a lot of our clients to minimize it or to eliminate it. And
fantastic.
So the third one is retirement planning. Obviously, as we're getting older, we need the income, not so much the capital growth. And also, we need to reduce the risk, the investment risk, because we can't afford to lose. The number 4 would be the trustee of the SMSF.
Okay.
Generally speaking, the two members, normally husband and wife, they are members and also trustees. But as we get older, we should consider having a company as a corporate trustee instead of just individually. It's easier to minister if one passes away. When it's more complicated if you've got 2 individual trustees and one passes away, there's a lot of paperwork involved. Whereas if you have a company, if one member passes away, then the company is a trustee, not the individual member. So nothing's really changed. So again, just repeating, death by nomination, potential death benefits tax if the benefits paid to adult children, retirement planning, revisit the investment strategy, reduce risk, review cash flow required, and the trustee of the super fund should consider incorporating a company to act as corporate trustee.
Yeah, brilliant. Han, thanks for that. That's very comprehensive. Certainly a lot of advice is provided in this area. Now, Han, one of the biggest, attractions of setting up a self-managed super fund is to hold a direct property. In your opinion, what do funds with aging members need to consider when they hold property in their super fund?
Sure, thanks, Adrian. So there's 2 questions I would normally ask the clients. One is, should I keep it or should I sell it? To keep it, then we need to consider, is the net rental from the property sufficient to service my lifestyle or the member's lifestyle? Especially you need to fund the aged care facility cost. And also, is there going to be any major capital improvement or repairs? And if so, where's the fund going to come from? Because if the super fund only got one property and all you get is rental income, there's no extra money you can sort of find to fund it, to cover the cost. Thirdly, with the property valuation keep going up, it will impact on the pension payment because the higher the valuation of the property, the more pension you need to take. But the rental income remains the same because, it doesn't go up. The rental income doesn't go as much, doesn't equal to the increment of the market value. So again, there'll be a shortfall to fund the pension payment. So again, how are you going to fix that up? And so, and lastly, probably more so for estate planning is if the member dies and the property is transferred to the adult children as part of the super payments, there'd be potentially stamp duty payable. So you should consider, is that something you want? There's stamp duties payable on the market value at the time of death, of course.
That could be quite costly.
Absolutely. And so maybe the easiest option, may not be easy, but maybe it's a good option, is to sell the property. And while the members in pension phase, there's no capital gains tax, right? And then with the proceeds, you can reinvest in a low risk environment where potentially get a return of 5 to 6%. And there's no running costs, no stress of holding a property. Probably much easier for aging members to take this option. However, obviously, the family need to agree with that, and yeah, that's something they need to speak to the family.
Fair enough. Han, you've been really kind with your time. Obviously, you're struggling out there, and you're going to stay back for some other questions I'm sure our audience might have for you. So we'll take a break from Han for a little while and get some water. Guys, when we provide advice, or the advice I provide in the aged care and Centrelink space, covers a whole lot of areas when we're looking to aged care. So it's not really a simple, let's work out some cash flow, do A or B or C. There's a lot of things that come into play: the family home, cost of care, Centrelink entitlements, estate planning. It's all involved, and basically we can provide comprehensive advice in this space. Additionally, you have multiple members and stakeholders. You're looking at this emotional journey at a time where mom and dad don't want to leave the family home. So sometimes it's helpful to have a third party as a source of knowledge and assistance to provide that guidance. At BG Private, we offer services in this area. Obviously, the initial meeting, we can have a Zoom meeting or an in-person meeting. It generally lasts from 45 minutes to 90. Specify the details similar to what we've gone through today, how they apply to yourselves, provide you with a quick estimate of cost and cash flow. And I guess you have this additional benefit with a financial advisor who's across various products over the journey of your parents to provide assistance and guidance. Then if you need, there's quite a few scenarios, you'd like it in writing, you'd like cash flow and projections, we provide strategic advice. That's the next level. And finally, if there's additional funds or you'd like us to review the existing investments, then we provide advice via a statement of advice. And obviously the costs are varying for what services you are after. LD will be sending you an email with the ability to contact myself and any other services at BG Private, so you can contact us and make inquiries. Now we'll open up to question time, and I've got Ildi taking charge of this. So if you've sent through your questions, we are here ready to answer them.
Terrific. Thank you, Adrian, so much. That was so informative. And we hope that everyone in the audience found it interesting and helpful as well. So we do have some questions that have come through, but if you want to ask some additional questions, there's the top menu and you can just click on the Q&A button and ask away, and we'll try to get to as many as we can in the next few minutes. So the first one, what are the common mistakes that people make in terms of entering aged care and structuring things financially? Maybe there's some mistakes they're making a few years out. What do you see? Anyone can answer this, Tim and Han as well. If there's anything that you notice that people, mistakes that people are making, I guess that's what they're asking about.
I guess the most common one is, and this is not a plug for our service, but you'll have people rushing into the decision because generally mum and dad need to move into care fairly quickly. And they're obviously saying, yes, we need to go into care. They're finally ready. They've said yes. So there's this rush. I guess my advice there is to take your time. You don't need to rush with these decisions. These are quite complex. They have a lot of impacts. So speak to someone. You can speak to, you commonly call them FIS officers, Financial Information Service Officers at Centrelink. You can come to a financial advisor. The aged care facilities are very helpful. Just in the last few days, because we've been promoting this webinar, I've been receiving tons of advertising from home care places. So, and their guides are fairly well set out and trying to remove the complexities of 800 pages down to 20 pages. So that's helpful. Another one that comes to mind is people who haven't paid the RAD, and they're not going to have assets enough to pay the RAD, but they're still sitting on $200,000, $300,000, $400,000 worth of term deposits, barely earning 4%, potentially paying a bit of tax on this, whereas they could have this amount paid to the RAD and save that significant interest cost of 7.61%. That's a big one. I guess, being in a rush to sell the house, yes, I advise people to sell the home in a lot of circumstances, but that's not always the most appropriate. And one of the reasons of putting the staggered entry into aged care is to show you the significant savings. So once again, in making decisions fairly quickly, most people enter aged care together.
Adrian, I had a question for you. How long it might take a bit of time to realise the cash to pay the RAD. Like if you want to sell a holiday house to help fund the RAD, that might take 2-3 months. Is there, like, what the aged care, when do they want to receive the RAD, and is there scope to sort of tell them, arrange that it's sort of paid effectively over, say, 4 or 5 months?
Yes, Tim, good question. There's some prescribed days that I don't know off the top of my head, but obviously the aged care facility asks you a bit of details about your assets, so they have a good understanding of where you sit. If you're telling them you're going to sell the property, then they know the funds are going to come. For them, it doesn't make a difference, because as long as the RAD remains unpaid, they're going to charge you interest. So in one shape or the other, they're receiving, I guess, their cost. They're covering up their cost.
Okay, I have just a couple to get through. If you are already living in aged care but haven't paid the RAD yet, so maybe it's within that first period, do the new or old rules apply?
So if you've already moved into aged care prior to the 1st of November, then the old rules apply. There is no retention.
Okay. And if you're already in aged care, is there an opportunity to review and assess your situation in terms of the new changes, or nothing about the new changes affects you positively or negatively?
So once again, very clear determination. If you've entered prior to the 1st of November, so that Friday, and lots of people were rushing, which kept me very busy in different calls, then nothing's changing. The old rules apply, except from that lifestyle or the extra cost. And there's another part I was going to say out there about reviewing. Now, lo and behold, I continue to find that a client's assets are not correctly updated with Centrelink. It could be from a few years ago when they had a lot more assets. And because their assets are not updated, that means maybe the Centrelink is not as high, the age pension is not as high, and more importantly, their aged care costs are higher. So it's a double whammy. So you need to make sure that information with Centrelink, because they share the same information, is up to date, right? So often you'll sell the family home, it's not updated because you can't see that as an option. Then you pay the RAD, that's not updated. So making sure that things are updated, so you're paying the right cost, receiving the right entitlements, And coming to an advisor or having it assessed means you can match up what you should be paying with what the invoice is saying to pay.
Okay. Yes, I've got one question here from Elaine as well. Can you run us through how much of the RAD is kept under the new legislation again? So you've run through it, but can you just run through that again?
Sure. Thanks for your question, Elaine. So you've entered from the 1st of November. There's an advertised RAD. Okay. The 2% is not calculated on the advertised RAD. It is calculated on what you deposit. So initially you might pay half of the RAD. So 2% is calculated. It's charged on a monthly basis. So after the 2% is charged in the first month, the RAD is actually reducing because they've deducted the 2%, right? Then the 2% is calculated on a lower amount, and so on and so forth. That's why the slides say up to 2%, because as it's being deducted on a monthly basis, the RAD is gradually reducing, and obviously the deducted amount is. Then as time goes on and you pay the balance of the RAD or another lump sum, then the 2% would be calculated on a higher amount. Effectively, after a period of 5 years, no more is deducted. And that is the value that will finally be refunded back to the estate. So
Yeah, so
hopefully that's clear, Elaine.
So if I understood correctly, it's up to that 10% could be.
Yes, up to,
Okay.
yeah.
Okay. Lucky last, if no one's going to add any more questions to the Q&A, I've just got one more question. Are there any strategies you recommend a few years out, so not directly before the parent enters aged care or the person enters aged care, but a few years out? Are there any strategies that people should put in place?
Yeah, most of the advice we provide is in retirement planning, and more clients who are coming to us in their late 50s and 60s, they've been helping their parents, so they are looking at aged care a lot more for themselves. And as part of the retirement planning advice, they're looking at the end, how will we afford this aged care cost? So as far as doing a bit of planning out far, it's definitely coming more and more to the front of conversations, because as you can see, the cost can be quite substantial. As far as for an elderly couple, as soon as possible, even for younger clients, get a power of attorney. It saves so much grief at the time when you're trying to negotiate. So, you're trying to rush through work and other responsibilities, trying to make an appointment, and then you reach the final line and they go, "Are you a power of attorney?" Some places actually ask right up front. So power of attorney, get those documents sorted, choose someone that you trust and is easily accessible. No point in having your favorite child as power of attorney who is residing in the UK or in the US. So make sure you've got people to help you, and there's plenty of help available.
Okay, terrific. And Elaine has just come back and said, so if you pay the full RAD, you don't incur the 2%.
No, so you will definitely pay whatever you deposit. You will be continue to pay the 2% on whatever is left over. So if you start the deposit with 500,000, 2% will be calculated on 500,000. After the deduction, the following month, the 500,000 reduces. You'll pay 2% on that reduced amount. So as long as there is a deposit, 2% will continue to be charged on that deposit, the leftover deposit, for a maximum of 5 years.
So no matter how much of the RAD you pay, you're paying 2% of that.
Correct, yes.
Terrific. Okay, thank you so much, Adrian, Han, and Tim. And for everyone who joined us today, we'll be sending out the recording within the next few days, as well as that link that you can make an appointment with Adrian, Tim, or Han at any time and seek their advice as well. Thank you so much.
Thanks, everyone.
Thank you.
Thank you.